Hello and welcome. This is Professor Spark, and today we're going to walk through selected topics from Chapter 12. I just want to remind you that ACC sessions cover selected material only, so you do need to cover the entire chapter. Make sure that you read it carefully, take your notes, and seek help if you have any questions. Make sure that you do complete all the coursework, and in addition, make sure that you're allowing time for self-quizzing. Chapter 12 covers the statement of cash flows. The statement of cash flows is the fourth financial statement. So as of right now, you have learned the income statement, the statement of retained earnings, and the balance sheet. This is the fourth and final statement, the statement of cash flows. What the statement of cash flows does is it looks at the cash on the balance sheet from the previous year to the cash on the balance sheet from the current year, and it looks at the change in the company's cash. Then it takes that change and it explains why you have an increase or a decrease in cash based on three different types of activities. There's operating, investing, and financing. These are the three main pieces of the statement of cash flows. Before I get into all the different pieces of the chapter, I do want to let you know that about 25% of your final exam is going to come from this chapter. So this chapter is very concentrated. The only topic that we're going to talk about is the statement of cash flows. So the things that I'm highlighting in this ACC session are things that you really need to make sure that you're spending good time on and that you really are able to complete the activities from this chapter. Many times students, because it's just one topic, they kind of just focus on chapters 10, 11, and then the cumulative portion of the final exam. However, because it's such a big piece of your final exam, I just want to bring that to your attention to make sure that you actually do allocate a good amount of time to chapter 12. So the first piece of this chapter is operating activities. This is cash in or out, so cash received or paid for just normal operations of the business. It could be, payment of your rent, utilities, wages, any types of cash payments for these types of things, purchase of supplies or inventory with cash, receipt of cash from your customers and sales. And then two items that go in this operating section but that you will not be tested on in this course is that you can receive dividend payments from other companies. If you're invested in other companies, that those dividend payments that you receive, your company receives, would go in operating, as well as interest for notes. But again, those will not be covered on the exam. Investing activities are, if you think about these as the same types of activities that you would do if you had excess cash. If someone handed you several $1,000s, what would you do to invest that? And some of you might say, well, I'm going to invest in stocks, or I'm going to put it in bonds. Okay, and companies can do that same activity. Or you might say, I'm going to buy a new car, or a new computer, or a new home. Well, companies can do that too. So the purchase of fixed assets like building equipment, land, vehicles, or long-term investments, so maybe a piece of land that has no building on it yet, or stocks in another company, bonds in another company, those outflows of cash would go in the investing activity. The same is true for the inflows for sale of these types of assets. So if you've got sale of equipment, sale of buildings or other fixed asset, sale of those long-term investments, the sale of stock in another company, sale of bonds in another company. The cash in or cash out from these types of activity would go in the investing activities section. Finally, the last section is called the financing activities, and these are going to be the way that the company gets financed or gets additional cash. So cash in or out, so cash received or cash paid from investing types of activities, I should say financing types of activities, would include receipt of cash from sale of stocks, so this is the company's stock, bonds, the company's bonds like we talked about in chapter 10, or notes. So if they went to the bank and actually borrowed money from the bank, and the similar payments for purchasing back stocks, for paying dividends on their own company stocks, for bond repayments or note repayments would all go in the financing section. So this is the first activity in your worksheet. And the first activity says, go ahead and classify the following activities as operating, investing, or financing. Now, this is the type of activity that I'm stressing you may see bits and pieces on the exam. On the exam, it may say, you know, paying cash for dividends goes in what section? So let's start though with A. If we issue common stock for cash, okay, what type of activity is that? That would go in financing. That's the way that you're getting cash, the way that you're financing your company. Letter B says, well, what if we pay cash for dividends? Again, that's a financing activity. Anything related to your company's stocks, your company's bonds, or your company's notes are going to go in the financing section. If you purchase inventory for cash, remember that's an operating activity. Okay, normal everyday operating activity. If you purchase supplies for cash, again, that's a normal operating activity. If you receive cash payments from customers, okay, again, an operating activity. If you sell long-term investments, ooh, that's that middle section, right? But you have excess cash and you have investments, and then if you sell them, it still stays in that middle section, right? So investing. G says we receive cash from a sale of building at a gain. Okay, again, sale of building, that's that investment. If you have extra money, you can buy a building, and the same thing goes for selling. It would stay in that investing section. Okay, and H says we paid cash for interest on a note, and that's kind of that one that I said isn't going to be tested, but that would be in the operating section. All right, so the book talks about two different types of ways that you can prepare the statement of cash flows. There's the indirect method and the direct method. I will let you read about the direct method, but essentially the thing that you need to know is that both methods get to the same result. Okay, so both the indirect and direct method basically are will still get you to the same cash in or cash out from the operating activities. However, we will focus just on the indirect method. And the thing about the indirect method is it's basically an adjusting method. You start with net income, which what I really like about this is that it's kind of like a puzzle. So you start with net income, and net income comes from the income statement. Well, when the entire statement is done, and we will not walk through the full statement in this session, but when you complete a full statement of cash flows, what you end up with is the ending cash balance, which ties to the balance sheet. So this great financial statement ties the income statement and the balance sheet and kind of finishes your whole set of financial statements. It's a puzzle in the fact that you know if you got to the right answer. If when you start with net income and you end with ending cash, if those two match up and everything adds up correctly, well then you know you did the statement correctly. Okay? But again, we're going to just focus on the pieces of this statement, not the full statement together. So the indirect method, which only affects the operating activity section, it would not affect investing or financing. But the indirect method of preparing the operating activity section starts with net income. From there, you add or subtract any adjustments that would not be cash. Well, the first adjustment is going to be depreciation. Remember that depreciation is an adjusting entry. All you're doing with depreciation is spreading out the cost of an asset that you purchased. So depreciation is really not a cash outflow. So therefore, we're going to add it back to net income because it was originally subtracted from net income, but we're adding it back. We're adjusting net income back so that net income, once we make these adjustments, will end up being cash in or cash out. Okay, and I put in there that you would also add back amortization or depletion, but in this class we focus on depreciation. Okay. Then if you have a loss on a sale of plant asset, again, the sale of the plant asset, the actual cash in or cash out, would go in the investing section. But the loss is going to get added back to net income because, again, that loss or that gain is not a true cash in or cash out. Okay, and same thing for gain. We take out any gain. So the cash in or cash out would go in the investing section, but the gain and the loss we would do the opposite here. So we would add back a loss or subtract a gain. Okay, and then we look at current assets, and this is everything except for cash, because remember this entire statement is adjusting for cash. So we look at all the other current assets of the company. any change in supplies or inventory or accounts receivable. And if it decreased, we add in the amount that decreased. If it increased, we subtract out the increase. And if you think about this like accounts receivable, let's say accounts receivable went down. If it went from $1,000 to $100, okay? Small company. So if your accounts receivable at the beginning of the year was $1,000 and at the end of the year was $100, well, that means that you collected $900 in cash. So do you see how the adjustments are basically taking our net income number and adjusting it back to cash? Okay, and then we do the same thing with current liabilities, except in the current liability section, we kind of go with the flow. If current liabilities increased, we add it. If current liabilities decreased, we subtract it. And a nice way to think about these adjustments, if you can kind of work on getting these adjustments down, net income plus depreciation plus losses minus gains plus decreases in current assets minus increases in current assets, and then plus increases in current liabilities and minus decreases in current liabilities. Okay, so if you can kind of get down like the major chunks of these, I can tell you that the nice thing about this statement is that basically you're doing the opposite of everything. So depreciation, you're used to subtracting that out. Now you're going to add it. Losses are usually negative, right? But now we're going to add it. Gains are usually positive, but now we're going to subtract it. And then again, current assets, if they increase, we're going to take them out. If they decrease, we're going to add them back in. So the only one that kind of goes with the flow, if you understand what I'm saying, so the only one that when it increases, we add it. The only one that goes with the flow is the liabilities. Everything else, if it's a negative, normally we're going to add it back in. Okay, so everything else here is the opposite of what you normally would do. Okay, so let's look at your worksheet and prepare that. Prepare a statement of operating, I'm sorry, not a statement, but the operating section. So again, remember what the little formula is. So net income plus depreciation plus losses minus gains plus or minus decreases and increases plus or minus increases and decreases in liabilities. Okay? And again, you can shorten these up. So like when I go to memorize this, I would maybe do current assets as CA or CL and just kind of shorten this up to a really confined little amount of information in my brain. Alright, so we start with looking for net income. So net income is found on the income statement. So net income is $18,200. Then we're going to add back any depreciation. Do you see any depreciation? Okay, also found on the income statement, depreciation is $36,000. So we're going to add that back in. Okay, the next item is gains or losses. And if I look at the income statement, I don't see any gains or losses, and there's no additional information telling me that we had a gain or a loss. Okay, so essentially I'm just going to put zeros here. You could exclude them, but I wanted to make sure that we address them. Okay, and then we're going to look at current assets. So where are current assets? They're found on the balance sheet. And here you can see 2007 is on the right, 2008 is on the left. This is a common way of reporting. And so just make sure that you're very careful. You pay very close attention to which is the old year, which is the new year. Okay, remember that we do not ever look at the change in cash because the entire statement is looking at the change in cash. So the first current asset we're going to look at is accounts receivable. And you look that accounts receivable went from 32 down to 25. So accounts receivable, an asset, decreased. So if an asset decreases, we want to add it back. So the change here between 25 and 32 is $7,000. Okay, and because it decreased, we add it back in. So we're adding a decrease in current assets of $7,000. Okay, next one is inventory. Inventory went from $54,100 up to $60,000. Okay, inventory, a current asset, when it goes up, we want to take it out or subtract it. So we're doing the opposite, right? So it goes up, we want to take it out. So we get the difference, $5,900, and we take it out. Okay, next we're going to look at current liabilities. First one is accounts payable. It went from $25,700 in the earlier year to $30,400 at the end of the year. Okay, so it increased. And remember that current liabilities are the only changes that go with the flow. So an increase gets added. Okay, so the difference between the two numbers there is $4,700. Since it increased and it's a liability, we add it in. Income taxes payable went from $2,200 down to $2,050. Okay, so that's a decrease. It's a little decrease, and because this is a liability, it goes with the flow. So we want to go ahead and take out that. So when we start with net income, we make all these adjustments that are non-cash adjustments. We add them up. We get $59,850 cash. Since it's a positive number, it's cash flow, cash inflow. So cash increased from operating activities by $59,850. And again, the biggest change from net income to cash increase was because of depreciation, because depreciation is a non-cash adjustment. When we depreciate our assets, remember dead, depreciation expense, accumulated depreciation, that does not affect cash. So $36,000 is taken out of our net income number that's not related to cash. So we add that back in along with some other adjustments, and cash increased by almost $60,000 just from operating activities. Okay, now let's look at investing activities. Remember, investing activities are from long-term assets, okay, fixed assets, and investments. So if you look at A, equipment with a book value of $30,000 and original cost of $45,000 was sold at a loss of $5,000. Now remember that loss is going to get reported up in the operating activities. We're starting off with a very difficult one here, because what we need to do is we need to figure out how much cash did we receive when we sold this equipment. Now this is back to Chapter 8, a little reminder of Chapter 8. Remember that in order to calculate how much cash you received, we could back into that by looking at what's the book value, our current book value, which they're telling us is $30,000, versus how much cash we got gives us our loss. Now the problem doesn't actually tell us how much cash we received. Okay, so the cash from the sale is going to be cash minus the book value gives us our gain or loss. Okay, we don't know cash, but we know that basically our book value was $30,000, which gave us a negative $5,000 loss, right? Or a $5,000 loss. So that means that we must have received cash of $25,000, right? So $25,000 less $30,000 means that we lost $5,000. Okay, so the cash alone is reported in the investing activity. Okay, the loss would get reported up above. Okay, B says long-term investments were sold for $80,000 cash, yielding a gain of $5,000. Again, in the investing activity section, all we care about is the cash. So if we sell long-term investments, we increase our cash. Okay, the gain, again, the gain would get reported up in the operating activities. C says we paid $35,000 for new equipment. Okay, well that's a decrease in cash. When we pay for new equipment, that decreases our cash. And finally, D, we sold land costing $200,000 for $350,000 cash, yielding a gain of $150,000. Again, what we're pulling out in the investing activity is the cash. So if we sell land, we're increasing our cash. Now when you add up these adjustments, basically cash from investing activities, cash increased by $420,000 just from investing activities. So we could have had a loss this year from this company. Okay, the first one and the second one are not related. We could have looked at this company and seen a loss but a positive change in cash, and this statement would explain that, because primarily we've got a huge cash inflow from the sale of this land. We sold a nice, valuable piece of land, which increased our cash. All right, the final one here that we're going to do is an example from the financing activities. Again, this is from your worksheet, and we're going to go through A through F. And remember that these are basically transactions from stocks, bonds, and notes. So A says net income was $35,000. Well, remember that net income goes to operating activities. It's not reported in the financing section. Okay, I'm giving you kind of tricky ones, A, to prepare you for your homework, but B, to prepare you for the exam. If you could very easily see an exam question just like this one, and you would have to know that net income is not reported on this section. Okay, B says we issued common stock for $64,000 cash. Well, if you sell or issue common stock, what happens to your cash? It goes up. Okay, C, we paid cash dividends of $14,600. If you pay for dividends, your cash goes down. Okay, and again, these are dividends on our company. Okay, D says we paid $50,000 cash to settle a bond payable at a $50,000 maturity value. Okay, if we paid cash, that's cash going down. E says we paid $12,000 cash to acquire treasury stock. Again, we're paying out cash. And F says we purchased equipment for $39,000 cash. Okay, that's cash going down, but be careful, that doesn't belong in this part of the statement. Remember that purchase of equipment goes to investing. Okay, so a couple of tricks in this problem, but I also want to make sure that you're on the ball when you're doing your homework and also on the exam, that you're watching to make sure that each transaction is truly related to the section you're trying to compute. So basically the cash paid in this section, okay, we had overall cash output and again, this should say financing. Cash paid for financing activities was $12,600. Okay, so I kind of want to stress the final exam here because so many questions come from Chapter 12. So 18 to 20 questions are going to cover Chapter 12. Well, as you can see from this ACC session, there's not a lot of, I don't know how to put it, it's difficult material, but there's not a lot of it. So you do need to make sure that you devote enough time to practicing Chapter 12 because there's a lot of questions. And Chapter 12 is very it can be very tricky for students, but there's not a lot to it. So what I want you to focus on is where would the activities be reported? So if we tell you that cash received from a sale of a building, where does that go? It goes to the investing section. If there's a gain or a loss related, the gain or loss goes to operating. Okay, so practice those types of activities. Make sure that you know where the activities fall on the statement of cash flows: operating, investing, or financing. Okay, know how to compute each section. So like we just did for the investing and financing, know what types of activities fall in each section. So you need to be careful to catch, oh, that activity doesn't belong here, and then know whether you are receiving cash or paying cash. So are you going to add it or subtract it? And then finally, just kind of as a final reminder, gains or losses on sale of long-term assets get reported in the operating section. So don't get confused whenever we're talking about a sale of an investment and there's a gain or loss. We don't care about the gain or loss unless we're completing the operating section. We care about cash in or cash out for investing. Okay, same thing for financing. Financing, we care about cash in and cash out. Okay, if you have any questions, please don't delay. Get to the tutoring center or contact me as soon as possible to make sure that you get over any sort of questions that you might have. All right, thanks for joining.